Hi, everyone. Today we're going to be covering chapter 14, which is all about investing in stocks. And I know a lot of you have already watched some of the videos and researched stocks for the stock market challenge assignment. So hopefully this chapter allows you to really dig deeper into the stock market and just how stocks work. And you'll notice that we are kind of jumping around the chapters, and that's because I wanted to cover this chapter earlier rather than later on in the semester so that if you decide that you want to make some trades, change your investments and what you've invested in, this chapter and the following chapter about bonds and ETFs will hopefully give you the perspective, a framework, and how to think about your own investment portfolio. So and they call, for those of you that have never invested, an investment portfolio is literally just a name that they give your investments, whatever you have decided to invest in, whether it's crypto, stocks, bonds, real estate, it's your investment portfolio. So whatever money you have dedicated to investing, and no matter where it goes, it's considered the folder or the portfolio that holds all of your investments. So again, investing in stocks. And I also want to highlight that a lot of us, when we think about stocks, we think about, um, you know, it's something that pops up in the news all the time. It's usually the first thing that we see, people talk about, or you see the ribbon displaying the numbers for the day. And you also see how whatever's going on in the world and at the federal level, at the state level, or even internationally sometimes might impact the numbers of the stock market. And so it's really neat to see and kind of keep track of what's happening and what are the effects on the market. So, for example, like when there's a presidential election, you always see it has an impact the following day on the stock market. So, there's certain events like COVID, for example, that had a huge impact on the stock market. And all of those basically events mean that either a stock that you're invested in might go down a lot or might go up a lot in value. And those we have this, I think, um sometimes it's just a popular view on, maybe it's sexy to invest in the stock market, right? Everyone's doing it. And for others like myself, I had no idea what the heck the stock market was, and I never invested in stocks. Growing up, my parents never invested in stock. My father has never invested in a stock to this day, and he's 71. So some people will never experience that investing in a stock experience, and some of us will have lots of stock in our life. And the idea is that um, we're gonna look at how the stocks work. We're gonna look at why people invest in them and the different strategies that people use, that investors use to make money off of stocks. So it doesn't matter if you're brand new to investing. It doesn't matter if you've already kind of got your feet wet a little bit with investing, but this chapter is hopefully going to give you the tools to understand one of the most common ways that people use to build wealth. And I think that's really kind of the takeaway that I want you to remember about this chapter is that wealthy people, all the wealthy people that I have known, and all the wealthy people that I came across during my time in the legislature when I would have to review people's investments for a gubernatorial appointment, all the wealthy people that I have ever known have investment in stock. It's a great tool to build wealth, and I hope that you can learn something in this chapter about how to do that for yourself and your family. And I know hoping that you all heard the hype that came a few years ago with GameStop, Disney. I think Tesla and Apple were also part of it. But there was a big hype of on stocks regarding those specific companies, and they were part of everyday conversations. And I hope that it gave you a little exposure to how to think of not only the stock, but the risk that comes from investing in those stocks. So let's jump in. So, learning objectives for this chapter, we're going to start first with looking at the different types of stock that are out there. We're going to look at how investors evaluate stocks when they're deciding to invest in them. And then we're going to look at what makes stock prices go up and down. We talked about some of them briefly. a moment ago, but we're going to look at that a little bit more in detail. And then we're going to learn how stocks are bought and sold. You have hopefully already learned that process through the stock market game, but we'll learn about some of the tools and websites, brokerages that you can use. It's basically like a bank that's dedicated to selling and buying stocks and bonds. And then we're going to look at some short-term and long-term investment strategies. These are going to be more for, if you're 20 years old versus if you're 50, you invest differently. And if you're young, you have decades and decades, of time that you can and be an investor, and you can, write out certain things that might happen with the stock market. But if you're older, you want more of that steady income, a more what you would consider a safer portfolio that that would make it easy for you to retire when you want to retire. Both are considered investors, but they just have different strategies. Let's look at the different types of stock that's out there. So the way that I know, like I said, a lot of you have already looked at the videos that I posted, but companies or corporations issue stock to raise money. So I want to give the example of Facebook back in 2012. I don't know if you are all, old enough, if you were too young to remember, but Facebook, small businesses will start and they grow. And when they're growing, they require more money to grow because they maybe need to open new locations, hire new people, make more of whatever product they're trying to make. And they need money to do that. And for private companies, some of them are able to use profits to build, their companies, but a lot of them they need like a huge amount of money to do what they need to do. And so one of the ways that they do it is they launch their companies through an IPO, and we'll talk about that a little bit later. But they launch their companies and basically make them available to the public so that people in the public can own a portion of the company. And so they go to an investment bank, and you have bankers that will do this huge analysis on the company to try to determine what a fair price for each share will be. And they do their best. They look at the company value, they look at what they believe the company's worth, they look at future earnings potential, all these different numbers. And after they assess all of those and make these calculations, they come up with a number for a price for the stock that they're going to make available to the public. So they sell themselves to the public, and now the public owns a share of who, of that particular company. So when that happens, that company then is responsible and accountable to the SEC, the Securities and Exchange Commission, and then they have to report earnings. They have to do an annual report that they release on the way on they release it. It's called a 10K, and they send that to the SEC and they make it available to the public, usually on their investor page on their website. But that becomes a document that everybody has access to. So anyone can look at that. They can look at the different numbers, what the company's working on right now. They release their income statement, their balance sheet. And so the public and the investors can look at that and decide whether they want to keep investing in this particular company or not. So they issue stock to raise money for growth and operations. And that is the main reason. So when you all bought your stock market shares, you're buying on the stock market exchange. So it's basically like a different way for people to exchange and buy and sell, stock. And it's a system. The stock market makes it easy for people to then go ahead and sell and buy and exchange as necessary. And because they're raising the money by selling a piece of their company, it's called equity financing. So you don't have to, you're buying a piece, they don't have to pay you back because you now are a part owner of the business. So it's a unique way to raise money versus getting a loan and then you have to pay back the loan and pay back interest. This approach allows the person to own a share. And so you never, as the corporation, they don't have to pay you back. And US stockholders get ownership rights and you own a piece of the company. And in some situations, dividends can be paid. And dividends are just like a payment that the corporation gives its shareholders every year. Sometimes they do it quarterly. And that's typically, I think, the common practice. But You get a little chunk of your shares, whether you owe 100 shares or 10 shares, however many you owe, you'll get a chunk of the company's dividend for the year. So they pay out this small payment. Maybe they're doing really well, and so they take a chunk of that and issue it and divide whatever amount to all of their shareholders, however many there are. So why do people buy stocks? Historically, the stock market has returned to about 10 to 11% per year, or in depending on where you look, but it ranges between like 8% and 11% a year, meaning that if deposit, let's say that you deposit, I don't know, maybe $100 into an account, you will get a return of $8 per year. And obviously, we're talking $100, like it's not a significant amount, but the key is that you start with 100 and you slowly, increase it. And the takeaway is that it's even though the stock market goes up and down, on average, it does always give you a return. And as an investor, you know that yes, it's going to go up and down. The stock market goes up and down, your shares will go up and down. But over the course of, I don't know, depending on how long you stay invested in the market, there is a return that is very, historically proven to take place, and that is somewhere between 8 to 11%. If you put your money in a savings account, and I don't know if any of you have ever had a savings account, but if you put your money in like Chase in a savings account, they pay you almost nothing. Sometimes I get 25 cents for the year for leaving my money at Chase in a savings account. So savings accounts pay very little in terms of giving you a reward for having your money in that account. And so the key is to find ways of getting that interest income or investment income, from wherever you decide to put your money. You want it to give you something in return. And that's how wealthy people keep their wealth. They acquire big chunks of money and then they put them in these accounts, whether it's a stock market portfolio or something like that, even putting it in a high yield savings account. And those are different types of savings accounts that pay more for an interest for leaving your money in that particular bank. But because this return is so different, like if you think about a savings account, it pays you 1% versus a 8 to 11% return for putting your money in the stock market. Well, you want to put your money in there because you will get a return. And historically, it has been shown that if you put your money in the stock market, you will get a return on that investment. So if you start with $100, and the key is to build up your savings in, the stock market, and we'll talk about different ways of depositing the money. But over time, if you leave $10,000, then you get $800 per year. So it's like a way to grow your money. And then that $800 gets added to your $10,000. Now you have, $10,800. And then that grows an 8%. And then you now have another $864, and so you just keep adding and accruing money on the money that you already have. And that's the key. Whether it's you investing in terms of having in a portfolio in the stock market, or even you putting it in a high yield savings account, the key is that you want to have your money working for you. And that is the key. And the stocks in particular make money in those two ways. They can make you dividends, or they can grow in value. So I have one of the stocks that I have, for example, and I'm not sharing this to tell you to invest in it. I'm just sharing an example. So please don't, take this a literal way of me making this recommendation, because I am a licensed financial advisor. So I have to be careful with my recommendations, but I just wanted to give you an example. I have an investment in the US stock market. It is a basket of US stocks, and I own a portion of a lot of different companies. And personally, I think this is the best way to invest, because you limit yourself from the risk of investing in one company that does something stupid, or they have a big recall, or the CEO does something stupid, and then the stock tanks or something, and then so does your investment. For me, it's better to have my risk spread out over a bunch of different stocks. And so that's why I choose to do baskets of stocks. But regardless, I own it's a position called SCHB, and I have it on the stock market challenge as well. And that particular position pays dividends every year. And then so I make money every year from that account. And I have it set up so that every time I get paid a dividend, I just have it accrue and reinvest in continuing to buy more of those same positions. So I make the dividends each year. And then let's say I bought it for $50 a share. And as it goes up in value, I also make money that way. And so there's two ways to make money for those investments. Now, there's two different kinds of stock. There's common stock and preferred stock. Most of us own common stock. This is the one that most of us are more familiar with, like just buying like Apple or Netflix. You get voting rights and the potential for growth. And then you have preferred stock, which is a little bit different. It's like owning a steady income stream because for this particular one, the way that companies are set up is that they will pay out dividends. But first, like assuming that the company makes money, they pay out dividends to the preferred stockholders first. And if there's anything left over, then they spread it out over all of the common stockholders. And so ideally, you want to own preferred stock, but it does, come at a cost. So it just depends. Typically when you're trading on the stock market exchange and whatnot, it's the common stock that you're focused on. But you get dividends regardless if the company's doing really well. But you don't get a vote in the preferred stock, but you do get, fixed dividends and you get paid first. So younger investors, they often go for the common stock for growth because there's that growth potential. And retirees might prefer the preferred stock because they want that income as they're getting ready to retire. So how do people evaluate stocks? I know, think about how you thought about which stocks you were going to invest in for your stock market challenge. And a lot of us pick just based on companies that we know. And I think if you are going to invest in individual stocks, I think it's good to believe in the company that you're investing in, believe in their growth, believe in their potential. But there are ways of assessing that. I think personally that as a new investor, this is overwhelming to kind of get into all these like in nitty gritty, but there are some people that really are curious and want to look at this stuff. So a lot of this is available on websites like Yahoo Finance or Morningstar. Looking at a stock is like shopping for a car. You want to know what's under the hood. It's not just about the name and what the public sees. It's about what is really happening at this company. So let's use Apple as an example to show you how this would work. So investors look at when they're thinking about investing for Apple, they'll look at things like earnings per share. They'll look at price to earnings ratio to see if it's fairly priced. And then if Apple earns $6 per share and trades at $120, its price to earnings ratio is 20. Comparing that to then competitors helps you see if it's over or undervalued. And so you'll look at either companies in the same industry or competitors, and you can compare these numbers, and it gives you a good sense of whether it's overvalued or undervalued. The other thing they look at is beta, and this one usually measures how much it goes up and down, like the volatility. If the beta is 0.8, it means that the stock is less risky than the overall market. And if it's over 2, then it's like very wild. So some investors love it, others avoid it. Like I said, for me, this is too nitty-gritty for somebody who's a new investor. So if you're starting, I don't know that you would want to kind of dive deep into all this. Personally, I think the fastest and easiest way is just to go buy a basket of US stocks because you get that experience and you learn. You can look up this same information for a basket of stocks, some kind of position like the one I mentioned, SCHB. There's like Vanguard US stocks, there's Fidelity US stocks. You can just search them and find the position name, and you can search it and look up all of these different things. But If you want to invest in specific stocks, these are good things to look at. You want to look at the industry, the economy, like if our country is going to pass crazy regulations as it relates to AI, then maybe you wouldn't want to invest in AI. So you look at the economy, you look at trends, you look at the industry of the company that you're investing in, and then you look at the more specific numbers, price to earnings ratio, earnings per share, how the company's doing and their growth potential. And that can be seen on their 10K, the report that they submit to the SEC every year. That should be public knowledge. And then you can look at the beta to see how volatile has this stock been over the last 5 years, 10 years, et cetera. And it should give you a sense of how how likely it is, how risky, how likely it is that it's a good investment for you given your goals, your age, and you should be able to make that risk assessment based on your risk profile. So how do we buy and sell stocks? Obviously, we have used our stock market challenge. We've already traded. The stock market challenge portal is meant to recreate the secondary market, which is the New York Stock Exchange, the NASDAQ. The primary market is considered the first time it launches, the first time the company sells itself to the public. That is the primary market because the people that buy the stocks are buying it directly from, for the first time from that company. So in the beginning of 2012, Facebook IPO'd, and that's what they call it. It's called an initial public offering or IPO. And when Facebook IPO'd, they raised billions of dollars and they basically sold themselves to the public market. And that was considered the primary market. And after that, then those people maybe sold their stocks um, and they sold them to everyday investors like us, where we, buy and sell, trade on the secondary market. You can place different types of orders within the secondary market. There's things called a market order, which is typically what we've done. And when I buy or sell a stock, I usually do the market orders. And what that basically means is that you're going to buy it no matter what price it is in at the time that the transaction actually processes. You're buying it at the market price. When you put a limit, it lets you set your own price. Like you'll only buy it if it's at this price or under. And then a stop loss automatically sells if the price falls too much. So it protects you from losses. And those are things that you can set up within the portals of the brokerages so that you can sell. I always just sell at market. It's easier. I don't have to go back and think of like a price, but it is sometimes beneficial to put the limit or stop loss orders when you are selling. And all of that is available in the portals, like I said. So when you're making the trades, you should be able to see some of this on your own within the stock market challenge portal because it's meant to mimic what it's like to make those trades with a normal, brokerage in the secondary market. So once you own the stock, the question becomes, how do you hold it or do you sell it? How do you think about the investment itself? So there's buy and hold, which that's typically what I do. I do a combination of all of these actually, but most financial experts will suggest or recommend the long-term approach because the market goes up and down. So the longer you can leave your money in the market, the more potential it has to grow and the more potential it has to make you income, right? So many of you have heard of Warren Buffett, I hope, but he famously buys and holds stocks for literally decades. Like he's owned Coca-Cola for over 30 years, which is crazy. But buying and holding is probably the best approach. You want to align it with your age and kind of where you are in your investment goals. But typically buying and holding is a good strategy. That's what I typically do. Then there's something called dollar cost averaging. It's another tool that you can use to benefit and grow your investment. And what the idea is that you buy because the market goes up and down all the time you buy, let's say you have $100 to invest. What you do is you separate that investment to invest at different times so that as the market is going up and down, you can capture, catch it when it's going up. You might also catch it when it's going down, but at the end of the day, it averages, your investment. So again, let's say you have $100 and you put you set maybe you have $100 and you put a chunk and you set it up to basically invest you could do every week, every month, etc. Sometimes when they're low, then that means that you bought really low. So as that increases in value, your investment will increase in value. But then sometimes, like I said, you might buy when it's expensive. And so at the end of the day, the idea is that it evens out, it averages out, and it reduces your risk because you're catching both. You're catching the stock as it's going up and as it's going down. So you're getting the best of both worlds. And then you have dividend reinvestment plans, which what I was talking about earlier. And this, as you're making money off of your dividends, it saves them until you can afford new positions, and you basically keep buying the same shares with the money that you're making. And so it's like that snowball effect where you're earning dividends, but then your dividends are helping you buy more stocks. So you're growing and growing and multiplying in terms of your growing that dividend income and making that even more substantial. So these strategies let time and compounding work for you so that you don't have to. And these are really where your money is working for you. But not everybody has that kind of patience. Not everybody likes, it's boring. This is the boring approach to investing, but it's the one that really makes your wealth grow. But some people don't like it, and so they want to chase fast profits. It's like gambling, right? There's short-term strategies that people use, and that's okay too, but you just have to be very careful because they're a lot more risky. So there's day trading, margin buying, short selling, and then options trading. When you see the word speculative, it just means it's riskier. Short term is typically riskier because the stock market goes up and down. And so if you're doing short term, then you're gambling that, maybe something is going to go up or down in a very short time. So day traders might buy Tesla in the morning and then they'll like sell it in the afternoon, hoping like by lunchtime, because you have to keep in mind that the stock market is on the East Coast time. And so it closes early for us on the West Coast. And so they'll buy stock like Tesla in the morning and then they'll want to sell it by lunch. And their goal is to make a few dollars per share. But overall, research shows that most day traders actually lose money. So it's a risky thing to do. I've done it before. I think we've all been maybe curious about it at some point, but it isn't always, it's risky. That's the big takeaway. Then there's something called margin buying, and that just means borrowing money to invest. So imagine putting $5,000 of your own money and then you borrow another 5,000 from your broker to buy $10,000 worth of stock. If it goes up, you double your money, right? You pay back the 5,000, and whatever money you made, you get to keep it. But if it goes down, you double your loss and you owe interest on the money that you borrowed. So margin buying is also risky. Then there's short selling. Short selling flips the game. So think about the GameStop thing. That's in 2021. That's what people did. Short sellers lost billions when the stock price unexpectedly skyrocketed because of that Reddit, blog or whatever it was that came out. And so short selling is also dangerous or risky. And then you have options trading. This gives you the right, but not the obligation to buy or sell stock at a set price. This one can be powerful, but it can also be very complex and risky. And most people have a hard time with all of these, in terms of day trading is easy. It's like, if you have apps like Robinhood, they've really made it really easy for normal, everyday people like us to invest. But when it comes to like options trading, short selling, margin buying, it gets a little more complicated. And I think a lot of people have a hard time keeping up when they partake in these. I think they have a hard time keeping up. And at the end of the day, data shows that boring long-term investments, are usually the winning approach. So key takeaways, what I would like for you to remember from this chapter is that stocks give you ownership and potential for high returns, but overall they're risky, which is why you have risk associated with them just because of the inherent nature of the stock market. It goes up and down, and that's just the way, the stock market works. So there is risk. However, there is that higher return potential than putting your money in a savings account. Historical data shows that the market does return, 8 to 12% a year or 8 to 11% a year, depending on how long you invest and all that. But you can even Google it, historical stock market return, and you get lots of articles and different reputable sources. You can see how other people will share the same type of information, so you can trust it. But like I said, it's easy to maybe put your money in a savings account, but at the end of the day, if you're investing it, if you have your budget balance, you have your emergency fund, there is earning potential in the stock market. You get that higher return. The difference between common versus preferred: common stock is about growth, preferred stock is about stability because it does provide that income. You always want to evaluate stocks carefully before buying. You want to look at earnings ratios and the risk associated, how volatile it is. For most people, long-term strategies are, the preferred method, especially if you have the time, if you're young, and you want to buy and hold. You want to do dollar cost averaging. Those really set you up to reduce that risk. And then short term is speculative, it's risky. So think about GameStop, and a lot of people made a lot of money and then they lost everything. It sounds exciting, but it's like gambling. It's like, it's like often it's a losing game for most people. And then remember that investing isn't about luck or chasing the next GameStop. It's about making smart, consistent choices over time. And I think that is what a lot of people get wrong about stocks. They want to invest in something and become millionaires overnight, but that's just not how it works. Investing is something that takes time. Growth from investments is something that takes time. So you want to give yourself the time and start early. If you're in your 20s, it's great. If you're older, you can focus on building more of that income and stability, but the idea is that you get started. So in the next chapter, we're going to look at bonds, and then in the chapter after that, we'll look at mutual funds, ETFs. So hopefully by the end of all of these chapters, you'll be able to take your background, your risk profile, your age, everything, and kind of decide what portfolio would be best for you in helping you invest, grow your investment, and then reach that, place your investment goals wherever you want to get, whether it's short term or long term. It should help you get there. But the key is to get that portfolio set up and to actually start investing.